Hello there, guys. In today's video, building on my prediction video for the ISM, I'm going to be looking at predictive type data for consumer sentiment. That's US consumer sentiment. So US consumer sentiment is very important, as we all know. So how could you go about predicting it or getting a confirmation signal? So one of the few coincident indicators that I follow is the employment rate of the United States. Why is that so important? Because it is completely linked to consumer sentiment. And so, what is my rationale for that? Um, if you can think back to when you were a teenager or when you were broke, um, you didn't have any money. And if you didn't have any money, you're usually probably not very happy because you're struggling to make payments to do the things that you want to do in life. So if you're flush with cash, you always know you're happier. You've got a spring in your step and you can go and buy drinks for your mates and go and do all the lovely things that you want to do in the world. So if more people are employed, then more people have money, and so that should boost consumer sentiment. And this is proven with the chart that I've got in front of you. So we've got US consumer sentiment scale on the left-hand side, and on the right-hand side, we have the US employment rate, but inverted. And you can see that there is a great level of correlation here. And it's precisely for those reasons. If more people are employed, more people have money, more people can do things that they can, the economy gets better, so on and so forth. Once the rate starts to creak, then that's it. That's it. It's game over for consumer sentiment. So if you can get leads on employment data, you should be able then to get leads on US US consumer sentiment. So let's see if we can do that. So here we are with the now rate of change for the unemployment for United States. And again, you can see with that, it gives you a nice, good lead from when the sentiment is going to change. Once that cracks from its highs or from its sideways motion, that's pretty much all she wrote for US consumer sentiment. And if US consumer sentiment is gone, as we can see historically, then that bodes a bad time for the US economy and the global economy. But what if we can break it down even further into the amount of hours the average United States citizens working, or the amount they're actually getting paid? Would that be helpful? I guess so. If you're getting paid more, or if you're getting more hours, then that means you're going to get paid more, and then so you should be happier if this logic follows through. And we see that too follow through. And so there's various numbers of charts here, and I'll be going through them here. So the top chart here in green, we have US consumer sentiment like we've been following. In the black line here, we have an addition of United States hours worked, average per week, durable goods production, and the service producing industries. So this is the amount of hours that they're working per week. And you can see once the hours per week starts to creak, so does consumer sentiment. It gets destroyed. Once they come back up, US consumer sentiment starts to come back up. And you can see that repeated throughout every business cycle. So it's a great lead for US consumer sentiment. You can break them down individually, like I've got them over here. So this is for the durable goods, and then here is for the servicing industry. And then another way of looking at it is also the payroll jobs. So this is how much they're getting paid. So we got the average. So we got the increase of time that they're working, where they're picking up more shifts or more hours at work, and now whether their actual pay packet is bigger, just because they're able to get CEOs or companies are able to give out pay rises or not. So if we go down here in the blue line here, we have the average hours worked, so of the durable goods. So that leads to consumer sentiment, as we know. And then here we have the payroll, so how much they're getting increases or decreases in wages. And you can see that leads the leader to consumer sentiment. And you can see once it breaks this kind of red line that I've drawn here, that's all she wrote for consumer sentiment. So we can see that here in the GFC.com and previous recessions that have occurred. So getting this data would be fantastic. Here are the RIC codes. If for whatever reason that doesn't seem to work, then I'll be showing you another great website where you can get this data. I'll just scroll down here. So it's called the St. Louis Fed, but you need to manipulate the data rather than getting it straight automatically and automated from Metastock. So here we are on the St. Louis Fed website, the first link. And then if we have to go to, oh, no, that one's already done for us. So you can see how that has changed going back for some time. And then if I just minimize that, and then I will go to the next link, which will give us the other indicator. So here we were looking at average hours worked per week, production hours worked. So now if we just click on this one, there's that. And then we can go to edit graph, and then we go to change from a year ago, automatically updates, and there we go. You can export this into Excel, manipulate it however you wish to. And then you've now got two leading indicators for US consumer sentiment. Pay attention to the links here up above, the URLs, save them, bookmark them, get the data. And so now you'll be able to know well in advance when US consumer sentiment is going to change. So hopefully that's been very helpful for you guys. If you found this video helpful, do like the video, do share the video, do subscribe to the channel, and also do subscribe to Metastock Xenith. It is by far and away the best trading platform for the retail trader. With the referral link down below in the description, you get 3 months for the price of one. Thereafter, it is $99 US, and I will see you in the next video.